Welcome back to Bong, Laureate, and this is Ms. Suman. Today I'll bring to you SSC CGL 2017 Tier 2 Paper 4 Part 3. But before that, let me remind you something. Please don't forget to subscribe after watching this video. If you like this video, please give me a thumbs up and don't forget to share it with your friends and beloved family members. And if you have any query or anything you want to know, then please comment. You can also reach us through our Facebook page. Please do visit it. And some of you asked me to give you some study material or notes so that you can prepare by yourselves and also can discuss it with other aspirants. So today I promise you I'll start giving you notes and study materials once I reach 1000 subscribers. So please do subscribe if you like my channel and help me to help you back. So let's start our video today. Today we'll learn about fundamental principles and basic concept of accounting part 2, which contains basic concepts of accounting, journal ledger and trial balance. This video today will cover the following topics: types of assets and liabilities, basic types of accounts, golden rules of accounting, journal ledger and trial balance, how to prepare them and their purposes, and the last one but not least, previous year's questions and examples. So let's see. Our first topic today is types of assets. Assets can be divided based on convertibility, usage or physical existence. Based on convertibility, assets can be divided into two types. They are current assets and fixed assets. So what is current assets? Current assets are those assets which can be readily converted into cash or money. And fixed assets are those which cannot be readily converted into money. They're possible to be converted into money but not readily. They are called fixed assets. Like the cash you have in your hand or in your bank account are called current assets, and the building or the land you own are called fixed asset. Why? Because the building or the land you own can be converted into cash but not instantly. They needed to be sold, then the cash has to be collected, right? So these are called fixed assets. Now, based on usage, the assets can be divided into two types. They are operating assets and non-operating assets. So what are operating assets? Those assets which are in use in business right now. And non-operating assets are which are not in use right now. Like suppose you have two shops and one of them are in use and one of them is idle. The one in use is a operating asset and the one which is idle is a non-operating asset. I think it is clear to you all. Okay. Then based on physical existence, the assets can be divided into two types. They are tangible assets and intangible assets. So what are tangible assets? Those assets which we can touch physically or we can feel them, we can see them. And intangible assets are those which are not physical, means they exist but not in physical world. I'll give the examples later. Let's go to the next slide. Now we'll learn the types of liabilities. Liabilities can be divided into two types. They are current and non-current. What are current liabilities? The liabilities which are to be paid within 1 year, and non-current liabilities are those which don't have to be paid within 1 year time frame. I think I'm clear. So let's see the examples of different types of assets. So the first examples we have are for current assets. So the examples of current assets are stock, inventory, fixed deposits, accrued incomes, bank balances, debtors and paid expenses. So it is clear that they can be used without any late. That means they can be used instantly whenever needed. So these are current assets. Now we'll go to fixed assets. The examples are land, building, plant, machinery, equipment, etc. These assets cannot be used instantly when needed. They need some time to be converted into cash. The next assets are tangible assets. The examples are all those assets which we can touch, see and feel physically, like the cash you have or the building or the machinery or the car you have. Everything is tangible assets. Okay, now I'll go to intangible assets. Which are intangible assets? Those assets which we cannot feel physically, like goodwill, patents, copyrights, brands, trademarks, etc. If you remember that in our last session I asked you a question that which is not an asset, and the options were money, real estate, car and reputation. So most of you answered that reputation may not be an asset, right? So see, reputation is also an asset and it is of intangible type, and money, real estate, car, those are also assets and they are of tangible types. So all of them are assets. So the question is wrong actually here, and in SSC we have seen that some questions come which are wrong. So don't freak out when you come across one. There are questions which are wrong. You don't have to be anxious about them, just skip them. And the fifth kind of assets are operating assets. The examples are cash, bank balance, inventory, plant and equipment. So these kind of assets are which are in use right now. Like the cash or bank balance you can use anytime. But the non-operating assets like all assets which are of no use for daily business operations, like some ideal machinery or some ideal car which are not in use right now, they are all non-operating assets. So let's go to the next slide. In this slide, we'll learn about basic types of accounts. Accounts are basically of three types. First one is nominal account, second one is personal account, third one is real account. So what is a personal account? The elements or accounts which represent persons or organizations. Like suppose you go to a bank to open an account for yourself or your shop. So what the banker will do? They will open an account in your name or in the name of your shop. So that account will be a personal account. The second one is nominal account. What is the nominal account? The elements or accounts which represent expenses, losses, incomes, gains, etc. So it is the account in which you keep record of all your expenses, losses, incomes, gains, profits, etc. Right, so the examples are salary account, interest received account. Okay, the third one is real account. What is the real account? The elements or accounts which represent tangible assets. That means the assets which exist physically. We already discussed about that. So the examples are cash account, furniture account, stock account, etc. Okay, now the real deal has started and we are going to learn about golden rules of accounting. So about this, the first thing you have to understand is that whenever a transaction happens, this transaction is considered to be happened between two parties or entities. Suppose you go to a store to buy some goods. When you pay the store owner some money and you get some goods in return, the store owner will be considered an account and you will be considered an account. Right. So in this fashion, whenever a transaction happens, the transaction happen between two parties. Okay, so the first golden rule is for the nominal accounts. What is this? Debit all expenses and losses, credit all incomes and gains. That means all the expenses and losses are to be written on the debit side of the record and all the incomes and gains will be written on the credit side of the record. The second rule is for personal accounts. So what is the rule? Debit the receiver and credit the giver. I think it is clear to you all. Okay, the third one is for the real accounts. What is this? Debit what comes in and credit what goes out. So whenever you buy something, that means you get that object. So the object comes in. So it will be written on the debit side and the cash goes out, right? So it will be written on the credit side. Am I clear? So let's go to the next slide. So we have learned all the prerequisites. Now we'll actually go to our main topic of the video, and that is journal, ledger and trial balance. We'll start by knowing the definition of journal. A journal is a detailed report that records all the financial transactions of a business so that they can then be used for future reconciling and transfer to other official accounting records such as general ledger. So journal are basically a list of information and they are very easy to comprehend and any accountant in the world can understand them. They are also very convenient for further applications. We will see that in example. So let's go to ledger now. A ledger is the principal book for recording and totaling economic transactions measured in terms of monetary unit of account by account type with debits and credits in separate columns and a beginning monetary balance and ending monetary balance for each account. Don't go to the technicality of the definition. We'll see the example, then it will be very clear to you. Now trial balance. A trial balance is a bookkeeping worksheet in which the balances of all ledgers are compiled into debit and credit columns. The general purpose of producing a trial balance is to ensure the entries in a company's bookkeeping system are mathematically correct. So as the definition implies that trial balance is produced to check the correctness of an accounting book, and it will be very clear after we see the example. So let's go to the next slide. So here comes the much awaited example on journal, ledger and trial balance. So what it says prepare a journal for the following transactions and then create separate ledgers for each account. Finally check the accuracy of the records by producing trial balance. And here 5 transactions are mentioned, numbered 1 to 5. The first one says purchased goods for cash ₹1,000 on 2nd October 2001. So you can see that in each transaction one date is mentioned and a definite amount of currency is also mentioned. If you're an accountant, then you have to keep an eye on this, that each transaction have to have some definite date and some definite amount of currency. It is a mandatory. Okay. Now the second transaction says purchased furniture for cash rupees 2000 on 5th October 2001. In that manner, 3 other transactions are mentioned. So let's go to the next slide and check for ourselves how the journal is prepared. So let's go. So here you can see the general layout of a journal. But before we start our discussion on how a journal is prepared, we have to understand this thing that any transaction happen between two parties or entities. One party gets something in return for something else. So you won't get something if you don't pay something, right? Here all the transactions are recorded from the business point of view. That means one party here is considered to be your business. So let's go to the journal layout. Here the journal has 4 columns. First one is for date, second one is for particulars, third one is for debit, and the fourth one is for credit, right? As the name suggests, the column for date will hold the date of specific transaction. The column for particulars will contain the details of the transactions, and within details it will hold the name of the two parties or accounts or entities. Then there will be a narration for each transaction. It will also contain the important details about which party is getting which goods, and it will also mention that which thing is being debited and which thing is being credited from your business perspective. Let's see the first transaction on 2nd October 2001. It says purchased goods for cash rupees 1000 on 2nd October 2001. So in the journal we can see that date is mentioned 2nd October 2001, and in particulars it is written purchase account debited to cash account. That means the goods we purchased is debited to purchase account in return for cash. So the cash is credited, and the narration is written being purchased goods for cash. Narration start with being. Alright, now how to decide which part will be debited and which part will be credited? For this, we have to know the golden rules of accounting. That's why I already mentioned them previously. Alright, so cash account is a real account, and for real account, the golden rule is debit what comes in, credit what goes out. So here the cash goes out, so it will be credited, and the goods which are purchased comes in, so they will be debited. So in the debit column we have written 1000 for the goods purchased, and we have credited 1000 for the cash. So now we'll go to the second transaction. The next transaction is purchased furniture for cash rupees 2000 on 5th October 2001. So in the journal we have written the date in the particular column, and we have debited the furniture account and credited the cash account, because furniture and cash account both are real accounts, right? So the furniture account will be debited because the furnitures come in and the cash goes out, so it will be credited, right? The next transaction is sold goods for cash rupees 50,000 on 12th October 2001. So in the journal we have written the date 12th October 2001 in the date column, and we have debited the cash account and credited the sales account, because sales account is a nominal account, and for nominal account the golden rule is debit all expenses and losses, credit all incomes and gains. Sales is a type of gain or income, because by selling something you get money. It is a gain, right? So it will be credited. The next transaction says paid salary of rupees 5,000 on 12th October 2001. Now paying salary is an expense, right? It will be considered as debit because it is a nominal account, and for nominal account, debit all expenses and losses, credit all incomes and gains. It is an expense, so it will be considered as debit, right? So salary is debited and the cash is credited. And in the next transaction, we will see paid rent for rupees 3000 on 15th October 2001. So here the rent is also an expense, and for expense being a nominal account, the rent will be debited and cash will be credited. It is written in that manner. The rent rupees 3000 is debited and the cash rupees 3000 is credited. So this is how the journal is prepared. So let's go to the ledger now.